Well, good afternoon. Welcome to our latest virtual Stone Barn Speaker Series. This is Ward Keever and Michelle Fisher of Covenant Wealth Strategies. Today is Thursday, January 21st, 2021. And we are delighted to have as a returning guest speaker, featured guest speaker, Ryan Dietrich, who is the Senior Vice President and Chief Market Strategist at LPL. And Ryan, I would merely like to point out that last June when we were together, which by the way, your presentation generated rave reviews and critical acclaim, and we had a wonderful time together. Right after that presentation, you were promoted to Chief Market Strategist and Senior Vice President. So congratulations to you. Great job.
Thank you. I can't wait to see what happens next. I'm going to keep coming on with you guys if they keep giving me more money. This is awesome.
More money, promotions. I'm pretty sure you'll be one step below God after we're done today.
I'll tell you that I'm busier though. They might give you a little more money and promote you, give you a different title, but oh my goodness, it gets busier. So there's some pros and cons, but it's been a wild ride. And I'm honored to be back.
We are looking forward to having you with us, Ryan. So Ryan, as I mentioned, is Senior Vice President, Chief Market Strategist at LPL. And as part of that is part of the Tactical Asset Allocation Committee and responsible for directly impacting portfolio decision-making process at LPL, as well as a member of the Market Insights team, where he develops and articulates equity and general market strategy. In his role, he is a frequent presenter to clients, such as we are going to enjoy today, as well as industry peers and the national media on emerging and developing market trends. Prior to joining LPL, well, I don't know if that even matters, but prior to joining LPL, Ryan was building his market knowledge and solid analytical skills. He was a senior portfolio manager at Haberer Registered Investment Advisor, managing sector asset allocation and strategy for high net worth client portfolios. Earlier in his career, he spent over a decade at Schaefer's Investment Research. His research and market analysis utilized both technical and fundamental, as well as sentiment methodologies with a focus on market expectations and advanced option strategies. During his tenure, Ryan was the company's primary spokesperson and still today is widely quoted in national media outlets, including appearances regularly on business television and radio programs, including CNBC, Bloomberg Television, and Fox Business. Ryan earned his CMT, Chartered Market Technician designation, as well as a BS in Finance from Xavier University, an MBA from Miami University, and also holds his FINRA Series 7 and Series 66. Ryan and his wife, Emily, moved from Cincinnati to Charlotte about 4.5, maybe 5 years ago now to join the LPL team. And they brought along their family, Susanna, Sebastian, and Gus, their 3 kids. Ryan spends a lot of time coaching his 3 kids' sports teams and driving around the neighborhood in their golf cart, which I don't think you did that much in Cincinnati, but you get to do that now down in Charlotte. So we are really thrilled to have you with us, Ryan. And without further ado, would like to turn it over to you and look forward to having you educate our guests this afternoon.
Well, again, thank you, Ward. I'll share my screen in just one second here and show the slides. But so I do coach my boys at basketball, a couple different basketball teams. One of them's undefeated. One of them lost last Saturday. So we're 3-1 in one and like 4-0 in the other. And I'll tell you, that loss has hit me harder, I think, than the bear market did earlier this year. Anyway, you show what my priorities are. But nonetheless, it's a lot of fun. And I've been with LPL for 5 years now. 5 years just
that is quite quickly. I remember when you joined.
Yeah, like 10 days ago. I think I started like the 11th or 12th, something like that in January. So right about 5 years ago. So it's amazing. It feels like a while, but at the same time, it feels really fast. But I tell you this much, I'm really enjoying it. It's a blast. But let's just get into it. I'm going to share my screen. Cross our fingers this works. It worked earlier when we tested it. Here we go. Share. There we go. You guys should see that screen. So again, welcome. Honored to be back. I guess I was on, like we said, last summer. We pointed out then that things were scary. The economy was not in good shape, but from an investments point of view, we really saw some solid opportunities. Fortunately, literally as we speak, we're flirting with new all-time highs, had an amazing rally. We're going to talk a little bit about the year that was, because 2020 was unbelievable in so many different ways. But then obviously focus a lot on 2021 and kind of where we see things going. Oh, actually, let's leave this here for a minute. The disclaimer slide. You think about last year, a year ago right now, we've been sitting here and things are going pretty good. Economy's coming back. The stock market's making all-time highs. And February 19th is when the music stopped. And then we had that 6-week sell-off, 34% correction, fastest bear market ever, fastest 20% correction ever. Economy was if you're driving a car, how do you stop it? Well, the economy hit a tree, okay? And it's like this now, here we are trying to build up from that. And that's what we're going to really dive into here. You can email your questions there to Michelle. We'll share this slide again at the end. But if any questions pop up while I'm talking, feel free and send those to her there. And again, we'll share that slide at the end. You can send questions at the end. Yogi Berra, the future ain't what it used to be. I think that's one way to. I like to say every presentation you guys ever see needs to have a Yogi Berra quote, I think, and that's a good one, because again, a year ago, the future, maybe it's going to be pretty good. Well, didn't turn out so good if you look at 2020. But again, there are a lot better times ahead, in our opinion. And I think it was interesting. I was talking with someone today about this. So last year, the economy did very poorly, right? We had a recession, earnings were down, yet the stock market gained like 16%. If you look at the S&P 500, even more on small caps, technology, NASDAQ was up like 40%. So there were some really good things that happened from an investments point of view last year. Yet the economy obviously didn't do so well. You fast forward to this year, we wouldn't be we think this is bull market's alive and well. I want to be very clear there. We think stocks will still do well, outperform bonds. We wouldn't be shocked maybe if you have a little flip-flop though, where the economy starts to do a lot better this year, and maybe stocks that were looking ahead to that better time, they don't do quite as well. We still think the S&P, believe me, it can gain high single digits, maybe crack 10% or so this year. And there's some other areas we think will do better. We'll get into all that. But it'd be interesting to see how this plays out. We think the economy do a little bit better than the stock market, the flip-flop, if you will, of last year. Speaking of last year, here's a good way to sum it up. Little old lady with her husband sitting around watching the TV, and she says, you know what? If we're going to watch the news, I'll need my glasses. So she gets up, go get her glasses. She comes back. She's got her glasses, double fisting. I think if any year ever double fisting, it was 2020. So Ryan Dietrich, Chief Market Strategist with LPL Research. I guess last time you guys saw me, I was the Senior Market Strategist, and like Ward just said, I was promoted, so it's an awesome opportunity to kind of do more of these and meet with our clients and have a bigger voice on our team. We've got a 30-person research team that managed over 50 billion. We cracked $50 billion mark late last year, so it's not lost on us. The responsibility that comes with that, and with me, with my voice, and I really love it. Sometimes there's sleepless nights. I think look back to March and April, how we survived. It was quite busy. But then you get, to the other side of things, and a lot of the things that we said and the way we invested, people's money actually worked out. And that's what obviously makes it so worthwhile. I'm a big fan of Regis. Regis obviously is one of the many people that tragically passed away last year. He said, I'm involved in the stock market, which is fun and sometimes very painful. Doesn't that sum up 2020 in a nutshell? I think it really does, because it was a lot of fun making new highs early in the year, and even fun late in the year making new highs. But in that middle part, oh my goodness, was it painful. Now think about Regis. Actually, before I go there, let me go back to that real fast. Regis was on TV for 17,000 hours. Guinness Book of World Records. Okay. I go on TV. I did a hit with the NASDAQ earlier today, and I go on CNBC. I think I'm on CNBC next Wednesday, sometime between 6 and 9 a.m. Let's cross our fingers it's closer to 9 a.m. than 6 a.m. Eastern time, but you never know. So anyway, if you like some of the stuff I said, wake up early Wednesday and check it out. But nonetheless, I go on TV for 5-10 minutes a week, give or take. There's a lot that can go wrong. An interesting thing about me, if you ever see me live, hit pause. Here I am on live TV playing an imaginary turntable. I turn orange. I joke when I'm lying, I turn orange. So be very careful the shade of my skin as we do this discussion. I do weird things with my fingers. I like to think in real life I don't do that, but I guess I do. There I am again. That's Angry Ryan. That was on March 23rd. I have no idea if it was March 23rd. That was the day the markets were down 34% from the highs. But there's Angry Ryan there. Funny thing about TV, they don't tell you when you're on TV. I'm on TV with Tyler Matheson, just taking a nice big drink of water on live TV. You don't get to see that every day. There I am doing a webinar from home. I'm actually at home right now. I'm not in that room because there's a ghost in that room. So I'm in a different room. I don't want to go to that room anymore. So if you see me jump up, you know why. All right. Enough of that stuff. Here's one of the charts that I've shared a lot. I probably shared it with you in June, but it's good to go over it again. This might sound odd because it feels like a lifetime ago. Stocks did awesome in 2019, okay? The S&P 500 gained over 30% in 2019. It's amazing. It doesn't even feel like that, but nonetheless, it happens is what I'm going to get at. It happens. What happens next? This is a chart I shared a lot last year at this time. And you see here it is. When stocks gain over what I go with, I guess over 30%, the next year is usually pretty strong, up 15% on average, higher 10 out of 12 times. Ooh, momentum. I know you guys look at momentum to a degree in some of the investments you make, and momentum works. I mean, sometimes when things are going up, they keep going up. There's more to it than that. We'll get into it. But this is a powerful one that we talked about last year, saying, up 30% normally is pretty good. And then at the end of the day, S&P gained 16% last year, almost an average year, anything but average, but an average year after you have a big gain. So kind of fascinating when you think about it from that point of view. The other thing about last year, we had the coronavirus, economy shut down, wild moves in the stock market, the election. We'll talk about the election, some of the impacts of policy here in a second. But one of the big picture things as I talk about the review of 2020 is the economy remains undefeated. And I know I shared this chart with you guys back then because this was an important chart. We said then, if you have a recession, the incumbent president loses. If you don't have a recession, the incumbent president wins. Very simple. I mean, it's very simple, but it's at the same time, it makes sense, right? If things are going well, you probably like the guy in office, and maybe you don't like him that much, but hey, the economy's doing okay, my stock market's doing okay, you might vote for him. Well, we had a vicious recession, and sure enough, the election came in much closer than expected. And we'll talk about some of those things. But still, President Trump obviously lost. Now we have President Biden, and you could say the recession played a big part in that. So the recession remains undefeated. And the last time the recession or the economy was wrong was Coolidge in 24. You had a recession before that election, yet Coolidge did win. I was also during the roaring 20s. Times are really getting moving. So kind of a little bit different than now, but just really interesting. So what else do we remember about last year? Devastation in March. I think that's when I hear 2020, I'm going to think of March. I'm not going to think of, eventually I'll get there, the massive gains we had at the end of the year from off the lows. But this is a picture of post 6 from the New York Stock Exchange. Check it out where it says INDU. That's a Dow Jones Industrial Average, upper left-hand corner, down 3,000 points. Guys, that's the largest point drop in the history of the stock market. That's on March 16th of last year. On a percentage basis, that's like a 12% drop. The Dow Jones has been around for 125 years. Okay, it started in 1896, so even a little bit more. 1896 is when it started. That's the 4th worst drop in the history of the stock market. 87 crash, 29 crash, and then a little trivia for you. The stock market closed for like 5 months during World War I. Then they reopened in December of 1915 and had a huge drop that day. Only those 3 days were worse than the day that we had on March 16th of last year. I mean, just truly, truly amazing. Last year was the first year in history where stocks were down 30% for the year and finished higher. Okay, I know we've got a chart on that. It might be next. It's coming up here. We'll go to that one. There we go. Right here. I'll go back to the other ones. That's what I'm talking about. The reversal we had was unbelievable. This is all the years that we've had since 1980. And the blue is the return. The little dot underneath is the max correction. All you got to know, guys, double-digit corrections throughout the year are perfectly normal. They happen a lot. The average is down like 14% from peak to trough per year. Yet obviously most years are higher, about 9% on average, on a long-term average on the S&P 500. Again, the only year that was kind of like last year was 2009. Stocks are down 27% at one point in early 2009, and then finished significantly higher by the end of the year, up over 20% approximately, or up over 20%. So that's similar. And you think about 2009, that was the kickoff to a pretty successful long-term bull market. We really think the action we've been seeing is the kickoff to a new bull market. I know that sounds kind of amazing. Yet, if you look at, small caps, for instance, which we like, you guys warmed to small caps a little bit. We agree there. Small caps just broke out of a 2.5-year consolidation. okay, late last year. So they went nowhere for 2.5 years. Yes, they're moving now, but it's all about kind of, it took some time. A lot of global stock markets peaked in January 2018, February 2018, went nowhere for years until late last year when they broke out. And that's a positive. So we get this upward momentum. It could be stretched near term. I'll talk about that. But bigger picture, 1, 2, 3 years from now, this consolidation that we did in a lot of areas is really a positive thing. Let's go back to where I was. So the 7-year itch. This is interesting. You think about things, there's studies that show after 7 years, people get tired of a relationship, a car, a job, whatever it is. 7 years, you kind of get that 7-year itch. You know what? The stock market's the same way. The stock market's very human. Okay. At the end of the day, it's all humans inside the stock market. Now, what I want to talk about for a second is secular bull markets. I'm going to spend a little bit of time on this slide. I think it's really important for people to understand. A secular bull market is when the stock market goes higher for like decades. We've seen this. Remember the 80s and 90s? That was a secular bull market. But what I want to show on the left, that first shaded area, from 1950 to 1968 was a major secular bull market where stocks went higher significantly for a couple decades, or nearly a couple decades. 7 years in, 1950, add 70 at 57. Recession and bear market. That's the area that's circled there. It doesn't even look like much. It looks like a blip in the whole scheme of things. Yet if you were around then and lived through it, it was pretty scary. And then stocks went higher for like another 10 years. Go to the other shaded area in the middle of the screen. Everyone says the 82 bull market. And I get why. Major low in 82 and stocks went up for 18 years. I think the bull market started in 1980, and here's why. Stocks gained 30% that year and also broke out to new all-time highs for the first time in like a decade. Okay, after a terrible, terrible investment period of the 70s. So from 1980 to 2000 was an amazing secular bull market. Add 7 to 1980, you get 87, 34% correction. I was in the second grade then, so I didn't really care too much. I've read a lot about the 87 crash. Crazy thing about the 87 crash, a couple things. We still don't technically know what caused it. I think it was as simple as stocks had a huge run up, like 40% for the year in August. Just the rubber band was stretched awfully far, and it came back. But the other thing, you read about 87 crash, and maybe some of you remember this if you were around then and paying attention. A lot of people didn't know about it till that night on the news. And even more people didn't know about it till next morning when they read about it in the paper, drinking their coffee. Could you imagine in today's world what would happen? I mean, like literally yesterday, I got a text on my phone. I look up and an alert from ESPN telling me Phillip Rivers retired. That's great. I mean, great player. I love knowing it. But the information that we have now is so over the top. Yet then people didn't even know about the largest, over 20% correction in one day in the 87 crash. But stocks corrected. Then they went up for another 13 years. Fast forward to right now. People talk about the 2009 lows, the March 2009 lows, and I'll talk about them in a second here. I disagree. I don't think that bull market started in 2009. It started in 2013. Look at the chart. For 3 periods from 2000 to 2007 to 2013, you know what the S&P did? Nada, nothing. No gains at all for 13 years. That's a secular bear market. Okay, so 13 years went nowhere. That was rough as we all invested through it and we all lived through it. The good news though, now the new bull market started in 2013. We broke out. Guys, add 7 to 2013. What do you get? The 7-year itch said 2020 might be a little trouble. Believe me, I don't think anyone expected a pandemic. I don't think anyone expected a 34% correction, but it happened. And now if history kind of plays out again, Churchill said the further back into the past we look, the further into the future we can see. Looking at the past tells us these 7-year itches happen. It's just part of investing, but there can be a lot more gains left. And I know I spent a good amount of time on that. I'll get moving a little faster, but I think it's so important for the average investor to be aware that there can be a lot more to this bull market left than when you turn on TV and hear everyone, whatever they're going to say. I'm a talking head too, so I'm half as guilty sometimes. But the truth is, this secular bull market has a lot of life left, in our opinion. What else do you remember about last year? Fastest bear market ever. There it is. 16 days to go from an all-time high to down 20%. We're going to remember that. 50-year outbreaks. Every 50 years we have a terrible pandemic. Every 50 years we have a market that pulls back about 30%. 1918 terrible pandemic. Market pulled back 33%. 50 years later, 1968 pandemic. Market pulled back 36%. 50 years later, another horrible pandemic that we're still dealing with right now, obviously, and stock market pulled back 34%. These are some of the things we were talking about with our advisors and with their clients. I've got a podcast, LPL Market Signals. You can listen to wherever you get your favorite podcast, a YouTube channel, LPL YouTube, do a lot of videos. We were talking about this stuff right then saying, listen, that was pretty scary. But hey, every 50 years, stocks pull back 30%. There's a pandemic. Maybe this could be a low with some other reasons. And sure enough, that played out. So kind of amazing how that happened. And the Mark Twain quote, history doesn't repeat itself, but it often rhymes. I love that quote. Largest reverse lever, already talked about that. One other one, then we're going to get moving into what we see this year. Off the lows, the magnitude of the bounce off the lows was unheard of, literally unheard of. What I'm showing here are the greatest 15-day rallies in the history of the stock market. The 15 days off of the lows in March, guys, gained 27% in 15 days. And I remember when that happened. Everyone was saying, wow, that's too far, too fast. We have to go back down. It's just a dead cat bounce. But we said, no, at LPL Research. So look at this. Previous huge 15-day rallies tend to resolve higher 3, 6, 12 months later, significantly higher 6 and 12 months later. And these are things we were talking about then consistently. I saw a lot of these different things that said, the last time this happened, stocks went up a lot. They didn't just roll over and go down. We pointed these out, and that was a real positive thing we saw last year in the midst of not a lot of positive. Now, you got to quote Anchorman in every presentation. They've done studies, 60% of the time it works every time. I just laid out a lot of different things, a lot of different numbers. That do suggest, the bull market's alive and well, but then you could have a pandemic. I think someone told me a year ago today was the first known coronavirus infection in the United States. And they'll quote me there, I heard that, but about a year ago is when everything started spiraling out of control. So you truly just never know. But I think what last year taught a lot of investors, or reminded a lot of investors, when things are on sale, use it as opportunity. If you got long-term investment goals, obviously work with Ward and the team, but when things are cheap is when you want to buy them, right? The stock market is the only place where when things go on sale, people run out of the store screaming. And if you've got money for 20, 30 years, or you don't need it for 20 or 30 years, if stocks go down another 20, 30%, we don't see that happening this year. I want to be very clear there. But if it does, you might want to use it as an opportunity, is what one thing we clearly learned last year. So let's power forward. Outlook 2021, LPL Research released their outlook not too long ago. And the bottom line, we have a car theme. We worked with our communications department, marketing communications, to create this theme. I think it's pretty cool. Things broke, right? Our car broke. Now we got to take it to the shop. Now we got to fix it. We know how we have to fix it, but we don't know if it's going to be the same. And we just left a world that we're never going back to. Okay. And that's kind of the theme. But the one thing we all have to do is power forward. There's no other option. We have to move forward. And that's kind of the theme of our outlook. And again, we see a lot of positive things, which I'll talk about here very, very soon. But I think it's kind of a neat way to look at it. You'll notice some of the imagery as we move along here. Policy. So what is policy? Think the Fed, think the government, think the way, Washington and spending and some of those things that are out there. I joke, I've done this for 22 or 23 years now, give or take. I never used to talk about policy. I never used to talk about the Fed. Now it's like I start off talking about those. I do think it's really, really important. So we have a new course when it comes to policy. Now, one of the questions that we've received a lot of is, believe me, the last 2 weeks, is the idea of a blue wave, right? We have a Democratic president. We have both chambers of Congress. What could that mean? Could it mean higher taxes, more regulation? Could it hurt your investments? That's a question we've received a lot of. So what I'm showing on this chart here is what the stock market's done under previous blue waves. The good news, does pretty well. About 9% on average, you can see there, higher most of the time, only down once since the late 70s. So to just blindly think of a blue wave could be bearish, and the other side of this, people could say a red wave's bearish, kind of depending on where you are, where you lie there. But the truth is, what matters more, and it's something we try to stress a lot, what matters more is the business cycle. Okay, the business cycle, we are starting a new economic expansion right now. We think we started it late last year. I'll talk about the economy next, but the economy really is the tides, right? You can go against the tide sort of, but eventually they're going to get you and push you one way. The economic cycle of growth is happening, and that's so very important here. So the makeup of Congress and who's in the White House and what's going on in Washington, people like to talk about it, and it does matter for policy. We'll talk about it some more here. Green energy. I know clean energy, green energy. That's a group that obviously is very has the tides behind it with Joe Biden, and we think that can be successful. So there's some pockets there, but just be aware that if the economy is strong and growing, that can make up for a lot of potential issues, if you will, coming out of Washington. Here's another way to look at it. This is interesting. This stuff I never used to even look at, but now I'm fascinated by it. We have a 50-50 Congress. We know that. Well, let me start with this. So these are all the Democratic presidents since 1900, what I'm showing you here. Look at where it says House and Senate. Bunch of D's under it. That means every single time we had a new Democratic president, guess what they brought with them? the House and the Senate. It would have been more rare if Georgia didn't go the way that it did for actually to have a split Congress coming in. It hadn't happened since 1886 with Cleveland, I believe, who the president back then. So that's what more rare. So the fact that we have the 50-50 split in the Senate with the Madam Vice President with the tiebreaker, but the House, look where House majority, look at that number in the House majority, 11. Now, it might have changed a tad since then, but bottom line, that's the smallest majority the Democrats have had in like 130 years. And it's a 50-50 split Congress. So you think about it, one of the main reasons, our opinion, the stock market had literally the best rally ever from election day to the inauguration, up like I think 14.5% approximately, was because we didn't have a major blue wave. We had a blue wave, yes, but we didn't have the major blue wave. And then we talked about it last time. Gridlock can be good. You want a Washington that doesn't sway too far one way or the other. Let's be honest. The market was kind of worried hearing some of those things about, adding Puerto Rico as a state or stacking the courts. Some of these more controversial things, if you will. Stock market might have not liked that. And wherever you lie, that's fine. But like the stock market probably wouldn't have liked it. It's not going to happen now because we've got a very divided of Congress here with some power to the left. And the truth is the left wants to make more spending, more stimulus. We'll get into some of those things. So those are some real positives that are out there. And that's, again, why the stock market's performed so well recently. And we think will continue to do pretty well. And then you look on the right there, how stocks do. Stocks usually do pretty well that first year of a new Democratic president with both chambers of Congress. Now, what other parts of policy are there? So there's a lot of spending coming. We'll talk about the Fed in a second. There's the $1.9 trillion plan. We don't think that's going to be that big. It'll probably be more like $1 trillion when all is said and done. Then the big fiscal plan is going to be this summer, when we're going to bring in infrastructure in and potentially more healthcare and some different things. That's when they're also going to talk about raising taxes. We don't see higher taxes this year. We see higher taxes next year. Think about the Great Depression for a second, if you want to. The government hiked taxes after the Great Depression. That didn't work so well. There's some other things that happened. Or when I say after the Great Depression, I should say after the crash of 29 and the initial recession. The higher taxes extended things. It didn't really work so well. We don't think the higher taxes are coming right away. You need the economy to get on better footing before higher taxes come, but they're likely coming. But at the same time, that's just an important thing to note. And that's kind of how we see it shaken out from that point of view. And again, it's a question we get a lot of. There's more regulation coming, no question about it. But higher taxes are probably further out. But now let's talk about the Fed for a second. So that's Jerome Powell. He is not your father's Fed. He's been on 60 Minutes 4 times in the last 18 months. We've never had a fair chairperson do that. I want to keep this fairly simple, but the Fed is doing a lot of things they've never done before. Guys, the Fed is literally buying junk bond ETFs. All you got to know is I never thought I'd say that. It's amazing what the Fed is doing. And I have some of the same concerns, if that's the right word to use, as you guys probably. The Fed is all powerful. Why is the Fed loaning money to small businesses? The Treasury. That's what I was going to talk about a second ago. If you could tell I was stumbling there. I was going to talk about the Treasury. The Treasury. Janet Yellen is back. She was the Fed chairperson a while back. She's now in charge of the Treasury. Okay, so that's another big reason we think stocks had such a huge rally late last year. You had good news on the vaccine. You had a closer than expected election without a major blue wave, and you had Janet Yellen back in charge of the Treasury. And what did she just say to Congress? I think 2 days ago. She said, "Listen, we probably shouldn't be raising taxes. We need to use more fiscal stimulus to get things going before we raise taxes." A little glimpse, if you will, potentially at some of Joe Biden's thinking. We know higher taxes are likely coming, but it's probably going to be pushed back a little bit further than people think. Stock market liked hearing that because you don't want to raise taxes right away on an economy coming out of a historically terrible recession. So the Fed's not going anywhere. That's good news. If you're from an investments point of view, going to keep rates low. The Fed has a lot of levers they can pull. On March 23rd is when the Fed really did what they call the Fed bazooka. They came out and just said they're going to backstop everything and buy everything. That's kind of what they said, honestly. The stock market bottomed on March 23rd, and it's up 70% since then. On March 26th, if you remember when I came on with you guys in June, I said we upgraded our view on equities March 26th, 3 days after a historical bottom. It felt uncomfortable. I was a little worried about it. Maybe I've had some sleepless nights thinking about, do we really want to upgrade our view on equities when markets getting killed? It wasn't comfortable. Our competitors and peers were not doing that, I can guarantee you. And we did. We added some equity exposure in a lot of the models that we run for our LPL advisors and for their clients. And fortunately, it worked out really well. We're really proud of that. And a lot of it's because the Fed said they're going to backstop it. The Fed backstop is still there, so be aware of that. We're going to have a correction, guys. Compliance doesn't like we make guarantees. I can't make a guarantee. But in all likelihood, after a 70% rally, We might see a 10, 15% correction this year. Perfectly normal, gonna be very scary. You're gonna call Ward, you're gonna wonder what's going on, why are my stocks going down? But it happens. And just be aware the Fed is still there, so maybe it's an opportunity. Maybe we're not so divided. There we have the House Speaker and the new president, right? Turns out they are, or what's the House? Yeah, McConnell. Sorry, McConnell and former Vice President. It's going to take me a while to get used to saying this. President Biden and McConnell. It turns out they're friends. You can be friends with the guy across the aisle from you. These are lifetime senators. Okay, that's the truth of the matter, right? President Trump was not a senator ever. President Obama was for like a minute. He had bigger, better aspirations that worked out pretty well for everybody. But these guys understand how Washington works. We're quite optimistic at LPL Research, that we can get these two to work together under the surface or behind closed doors and make things happen. When Joe Biden's son tragically passed away, the only Republican senator that went to the funeral, was on that screen. So they're really good friends. So we're optimistic that as divided as things still feel, and they are, that we can get some partisanship and some things happen here to succeed and make pull some certain levers to get policy in play and continue to help those people that really, really need it. So let's talk about the economy. I like this one, by the way. See that key with the LPL symbol? I like that. That's pretty cool. Vaccines are here. We have 2 vaccines with 95% effective rate. The truth of the matter is we need these vaccines out there so we can open up the economy. A lot of people are still struggling. Fortunately, like we said, I got a promotion in the middle of a pandemic. LPL Research and LPL in general has done really well. We're very, very fortunate with how things have gone the past year. And that's a wrong way to put it, because we know so many people are struggling, but LPL has been successful. Now, my brother, we'll talk about father-in-law. Father-in-law has a restaurant in Cincinnati. Okay, a year ago right now, they were sold out every single night with Open Table. Right, every night they were sold out, kind of higher end. And I saw them over Christmas, and they're struggling because people aren't eating out. It's in Ohio, right? There's different rules and regulations. You can't eat out. They don't really do the carry out thing. My brother, he sells GI Joes. I guarantee you, he probably has more GI Joes in his basement than anybody you've ever known in your life. That's what he sells, toys for a living. He used to go to the Holiday Inn and set up shop. You think they're doing that anymore? You don't do stuff like that anymore. Hopefully soon. But that's so many people are impacted by this. I know a lot of you on this call probably were impacted by, clearly, all of us one way or another, what happened. So it's not lost on me. I got a promotion and things are going pretty good. A lot of people are struggling. But the great news is the vaccines are here with a 95% effective rate. If you had an expert on last March or April, I could say with fair certainty they would not have expected 2 vaccines with a 95% effective rate by end of the year. That just didn't seem possible. It happened, and that's the beauty of it. And that's again probably why the stock market was up so much last year, because it saw these vaccines coming maybe when a lot of other people didn't expect it. Now, the J&J vaccine, let's talk about that for a second. These other vaccines, Moderna's and Pfizer's, you need 2 different shots, a couple weeks apart. And they need stored in these super freezers that take up all this room. You see pictures of these trucks with these big freezers, all the medicine in there. But the good news about the J&J one that's likely going to be approved in a few weeks, according to Dr. Fauci, is it's 1 shot with maybe an 80% effective rate. We don't know the official numbers yet, but 1 shot, and it doesn't need to be in these freezers. So think about it. The US, we're fine. We can use these 95% effective ones and even the J&J one, if you will. But for the rest of the world, it's so much easier to transport it. So, we're going to wipe out Corona within 6 months here in the US. 95% effective rates are things like measles and mumps. Okay, those vaccines are that effective. It just wipes them out. The common the common flu vaccine is only 42% effective. That's kind of amazing. I remember I got a flu shot a few years ago and actually got sick. I got the flu for like a day and a half, felt terrible. And I was like, man, I got my flu shot. And the doctor said, yeah, it doesn't always work, but maybe that's why you're only sick for like a day or so. So that's only 42% effective. But this is 95%. So that's really a positive thing. And more vaccines are on the way. It isn't what you look at, it's what you see. Henry David Thoreau. What I'm showing you here are all the expansions we've seen in our country's history. This one started in the summertime. It's not official when it started yet. We think it's fairly safe to say in the summer. What I really want to point out here is expansions last about 5 years on average. Okay, the last one was about 11 years, give or take, or almost 11 years. So be open to the idea that we're like a cruise ship. Once it gets going, it takes a while to move around, but once it gets going, it takes a while to stop too. That's the way our economy is. We're more of a developed country now than an emerging market, which you kind of stop and go faster. So just be aware of the fact that this cycle of growth really could last years. Now, will it last another 11 years? As of right now, we'd say probably not, because this economic shutdown that we had, well, everyone felt it for a while, but some people just kept on going. Okay, so it's not like this was a pure recession where things were reset. So we think, it might be more like the average, maybe say 5 years or so when all is said and done before a recession. But again, nobody truly knows. But that's kind of our base case, because not everyone had the same like a reset that you tend to have during a recession. And how do you sum up what just happened or what is happening? Everyone wants to know, what's the shape of the recovery? You might have heard this before. A V-shaped recovery is like it sounds, down and back up. W look just like it sounds. We've grown to the K-shaped recovery. What's a K do? Part of a K goes up, part of a K goes down. That's this economy. Parts of this economy are doing great and better than ever. Parts are struggling so much, retail and obviously anything live and anything face to face. And a lot of it comes down to income. That's what we're showing here, right? If you have a high wage, make high wages, make over $60,000, your unemployment actually went down. If you make less than $27,000, likely in the services area, in all likelihood, your unemployment went up. Okay, that's a K-shaped recovery, or the K-shaped recovery that we're in, where there are parts that aren't coming back. The good news, again, that vaccine matters so much to opening things up to the part of the K that's going down, and we're optimistic that can be the play. It's not me who can't keep a secret; it's the people I tell who can't. Honest Abe Lincoln, I love that quote by Honest Abe. What's the secret? The response. All I want to point out on this chart, which by the way is by our friends from Ned Davis Research, the blue. The blue is the amount of fiscal response this time versus the financial crisis, which is in orange. All right, so that's all you got to know. Look how much higher those blue ones are than the orange ones. The amount of fiscal stimulus we put in the system during this shutdown, or this recession, great shutdown recession, versus the great recession that we had 2008, 2009, is astronomical. And if you go back and read the books after the Great Recession, and they all made books, hey, why not? Everybody makes a book, makes a bunch of money. Guys like Geithner and Bernanke and Paulson, they all said about the same thing. They said, you know what? We wish we would have gone bigger with our fiscal response. We wish we would have kept the foot on the pedal longer with our fiscal response. The Fed knew exactly what it was going to do when the next crisis came. Bigger and longer. They didn't know how the crisis was going to happen. You just know there's going to be another crisis. And then obviously COVID hit, and they knew exactly what to do, which was put the pedal to the metal and use a lot of stimulus to get things going. And that's what this chart is showing. The one on the right, by the way, is Japan. We've warmed a good deal to Japan. We love the United States for an investment. We like emerging markets. We don't like Europe quite as much, developed international, but we think Japan is an area that finally can start doing something here after going nowhere for 30 years with all that fiscal stimulus. That's an area we do like, and that's a big reason why. Where do we see things? This is all a bunch of numbers. All you got to know here is we think we're going to have some pretty explosive growth this year. We're looking for 4.5%, maybe even crack 5% GDP, honestly, in the US when all is said and done. It's about what we lost last year, by the way, though. We think more growth is coming from emerging markets, right? Look at South Korea, look at China, look at Taiwan, Hong Kong, some of those areas over there. They've really done an awesome job beating the corona, or at least keeping it to the sidelines. And now they're showing some growth. You guys know the only country that had growth last year? China. It's kind of amazing. It's a cocktail, it's trivia stat there. But China actually had, I think, like 2.5% GDP growth last year. Now, I get it. No one truly trusts Chinese data. I trust what Hyatt says, though. Hyatt said there's more hotels that are booked now than there were back in September before everything started, obviously falling apart over there. So those are some real positives. I like emerging markets like the U.S. for some growth around the globe. We still don't see inflation yet. We can talk a little bit more inflation. Usually I get that question on the Q&A. Inflation worries me a little bit down the road, but we're simply not seeing it yet. Let's talk about stocks. Then we're going to do bonds and wrap it up and do Q&A. Earnings rebound may spark, I like that, 2021 gains. Another way to sum up 2020, where does it hurt? So there's a headache, there's a stomach ache, and there's 2020. That sums it up, doesn't it? The dead outnumber the living 14-1. Ignore such accumulated experience at your peril. Neil Ferguson, a historian. I like that because there's so much information out there. And believe me, these phones of ours, too much information can be a bad thing too. Don't get me wrong there for a second. I mean, I firmly believe that. But there's so much information from the past that we shouldn't ignore it. And what's the past tell us? Well, what just happened late last year is extremely bullish for this year. What happened in November, December? There you can see it on the screen. The S&P gained almost 15% those last 2 months. Guys, that was the best 2-month rally to end a year in the history of the stock market. Stock market was like flat going into the election, and then boom, gained 15% those final 2 months, and that was most of your gains for the year. So my question, I put this together, we've got a blog, lporesearch.com, daily blog. You can check it out, a lot of things like this. And I said, what does it mean? All right, well, what does the past tell us? Well, the past tells us when you have a huge gain late in the year, check it out. January is higher every single time. And I'll be very honest, I did not expect this January to be higher because we just had a huge rally. So, oh, maybe we'll sell the news type of deal. Now we've got what, about a week or so to go in January, and it's looking like we're going to have a positive January. So that you might check that off for a plus. They're being right. The other one, they look at the next year. Next year higher every single time with extremely strong outperformance. So again, no guarantees here. Every time can be different. We totally understand that. But kind of when I was talking about how when you gain 30%, that next year is usually higher. When you have a split Congress like we did last year, the 10 years in a row, stocks were higher. There were some things last year that said, stocks will probably be higher. And sure enough, they eventually got there. This is one of those things in the back of my head that says, it's a small sample size. If your statistics teacher probably be curious, I'm even showing you this because it's a small sample size. But I always say this, I wouldn't want to ignore that. That's something I wouldn't want to ignore because what happened, we have a podcast is called Market Signals. All right. We're looking for signals from the market using quantified data to show what potentially could be a path for the future. And this one says, again, if we have a dip, you might want to buy it. Let's see here. Time for a break. So we've had a 70% rally. All right. And obviously, hopefully I'm relaying that we think, things are pretty good here. Maybe things are too good. Maybe people are too optimistic. And that from a contrarian point of view could be time for a break. But I'll tell you, if you're bullish, and as a market strategist, I like to lean a little bullishly. But one of the best things that could happen is if stocks did nothing for 6 months. I mean, I know that sounds like 6 months of nothing. After the rally we've had, let them catch their breath. And here's what I'm showing. That dark blue is now. That's the rally now off of the lows from last March. The other two lines on there are the previous best two starts to a bull market ever, 82 and 2009. Tremendous rallies, obviously. And this one almost tracked them to a T. I probably shared this chart with you guys in June saying, listen, there could be a lot more upside. We're tracking this. It's possible. Be open to it. Now, history would say maybe a little break. And again, that'd be perfectly normal. You know what 2009 and 10 did? They look a lot like now, by the way. 2009 and 10. In 2009, we bottomed in March, rallied 70%. Then there was a quick 10% correction in January. Then it rallied back to new highs by the summer. And then there was a 16% correction in the summer of 2010. I don't think it'd be abnormal to say we'd have a 10% correction sometime early this year, rally back, a 16% correction after a 70% rally. That'd be okay and perfectly normal, and maybe a little consolidation for a while before we resolve higher. So that's kind of how we potentially see things playing out. Now, here's what gets me in trouble. People always say, what's your target? Where do you think the S&P is going to go? We've got a 3,900 on the S&P, and I'm aware that is like there. I mean, we are there. Now, the problem with targets is I hate targets. We have to give one. We had to put this together like in October. We had to release it in November, and then we have the best 2-month rally ever to end the year. So it's like, LPR research is not bearish. If we get to 3,900, we're not going to turn bearish. We manage a lot of money. The way we're looking at this is we think this cycle of growth has a lot of time left. The truth of the matter is we'll probably upgrade our fair value target sooner than later, but that's kind of out there on paper. What we're doing with the money that we manage, we're looking for an opportunity for a pullback to add to our equity exposure, add to our risk for a likely much longer cycle of growth and equity gains. Is kind of where we see things. Earnings growth. Earnings will be up as much as 25% this year. Earnings are amazing. What we've seen so far, last couple of earnings quarters have been beat expectations so much. So yeah, there's the Fed. Yeah, there's a lot of spending going on. The truth is earnings are coming back. We might see record earnings before this year is over. That's crazy because we just had a huge earnings recession last year. So think about how quickly things are coming back online. That's a real positive thing. And then we see higher yields coming. We'll talk about bonds here in a minute. Small caps, I know talking to Ward, he said you guys warmed a little bit on small caps. That's great because we have to. And this what I'm showing here is when you have a new cycle of growth, you know what tends to do better? Small caps. Just a refresher here, guys. Large caps have done awesome for like 10 years. Large caps have really beat small caps significantly for about 10 years. But again, now we got a new cycle of growth. Small caps do better on a new cycle of growth, and it can last for a while, out to 12 months here. You can see that where it says 12, you can see the significant outperformance out to a year later after a new cycle of growth starts. So we've warmed to small caps too. We upgraded our view of small caps back in September. We've been adding in some of the models that we run for our LPL advisors. So we think there's some potential there. Small caps at the end of the day are more domestic by nature. When the economy was a mess, 6, 7, 8 months ago, small caps got drilled. They were very weak performers, but they've quietly come back. One of the more amazing things that happened last year, and there's a lot of them, small caps actually by the end of the year gained more than the S&P 500. They were destroyed down like almost 50% or so at the lows, where the S&P was down 34%. But they came back, and it was a photo finish at the end, and small caps came back. And even for the year now, small caps, I just looked, small caps up like 8 or 9% for the year. S&P's up like 3 or 4% for the year. So really strong performance. And we think small caps, they've had a heck of a run. Maybe a little pullback or consolidation like I talked about, but we'd use that as an opportunity. We think in 2021, small caps can do pretty well. My son Gus, we talked about him. I coach his team. He was 7 at the time. I'm from Ohio, by the way, and Cincinnati. And we ate a lot of chicken. Okay, Kentucky Fried Chicken. Love Kentucky Fried Chicken. And my son Gus, we were driving around. He said, "Hey, Daddy, you see that guy up there?" I'm like, "Who are you talking about?" He said, "That guy." I said, "Oh, the Colonel Sanders." He's like, "Yeah." I said, "Yeah, what about him?" He goes, "Why is his body so small?" I looked down like, oh my goodness, Gus is right. Why is his body so small? I'm 42 years old. I always thought he had a goofy tie on, but apparently not. So it's all about perception. It takes an 8-year-old to realize that the colonel has a small body. Who knew? And it's just amazing. But what could we all agree on? Earnings. And I kind of talked about this. I won't spend too much time on it. Earnings are coming back in a big way, and it's not just a U.S. thing. It is a global thing. It is a global earnings expansion coming on. Emerging markets are going to see over 30% earnings growth this year in all likelihood. U.S. so about 22. We think again, U.S. maybe hit 25, and emerging markets maybe 35% earnings growth. Here's a little secret. When you have earnings growth like that, you don't have a recession. When you don't have a recession, you can have a bear market. It is possible. It's rare. But if we do have one, and again, it's not our base case at all, they tend to bottom and go up in a hurry. So again, these are real positives from the point of view of an economic expansion, which should do well for investments. And earnings matter, and we're seeing some real impressive earnings. Our friends in Japan have found a way to get rid of bears as market participants. We don't like bears. Japanese town deploys growling monster wolf robots to scare away wild bears. Kind of a silly thing, but here's the Nikkei. Remember, I talked, we like the United States. We like emerging markets a lot. We also warmed to Japan. Here's Japan, did nothing for 30 years. Some of you are probably going to say, listen, stocks are up so much. They've had such an amazing run. And I get it. That's large cap tech that's done amazing. You guys know financials have gone nowhere for 13 years. You know, energy stocks are still much lower than they were since 2007. There are pockets of investments that really haven't done anything for a while. Okay. And those are sometimes the ones that take the baton and do well. Japan's a good area. I mean, for 30 years, it went nowhere. Now it's starting to break out. A lot of places in Europe are lower than where they were in 2000. Okay. So there's some potential here for some other parts of the world, maybe finally start to do a little bit better. And we like emerging markets, and we like Japan. And I mentioned emerging markets. I think I've got you good. The next chart. So here's a picture of emerging markets. Steve Jobs said most overnight success stories took a long time. It's a really good quote by Steve. This is an overnight success story when you talk about EM, emerging markets. Again, for 13 years went nowhere. Remember I talked about the S&P 500 from 2000, 2007, 2013, 13 years went nowhere, then broke out. Had a really good run for about 7 years until the correction, obviously last year. We think emerging markets could be starting something like that. For 13 years went nowhere. Believe me, if you were overweight emerging markets, invested in them for 13 years, hadn't felt very good. You wish you were in the United States, obviously, for investments point of view. But we think things will be changing a little bit, and emerging markets really have a lot of potential as they've gone nowhere, and now they're starting to move higher. That's a good thing. U.S. dollar, we've been dollar bears. We think the U.S. dollar is going to be a little bit weak with some of the policies of Joe Biden and what the Fed is doing. All you got to know about this is a weak U.S. dollar tends to be a tailwind for international investments. Specifically, in our case, we think it'll be the emerging markets. A couple more, we're going to wrap it up. The reaction around what we saw of the election was unheard of, or almost unheard of. Only happened a couple times in history. 4 straight days, the S&P 500 gained at least 1%. Monday, Tuesday of the election, Wednesday, Thursday, stocks gained at least 1%, 4 days in a row. That's unbelievable, and it's only happened in 82, 74, and 70. Again, what happened after though? 3 months later, pretty strong. 6 months later, a year later, extremely strong. These are things we were talking about internally and with our advisors, and again on our podcasts and our morning calls with our advisors, and with the media when I go on TV and do things like that. We were talking about, listen, the reaction around the election is extremely bullish. So do not ignore the signal, what the market's trying to tell us. And again, that's another reason if we have pullbacks, and we probably will, to kind of, there's all these different things that line up for opportunities to buy at a cheaper price, and then likely a higher price when all is said and done. Let's talk about bonds, and we're going to wrap it up. Not too much on bonds. Generally, we see a better economy. We see a higher trending 10-year yield. Remember, yields go up, bond prices go down. We think stocks will outperform bonds this year, much like we thought that would happen last year. There's always a place for bonds in someone's portfolio, though. Back in March when the stock market got killed, having some bonds helped you sleep at night. There's no doubt about it. So there's some areas we like. I don't want to get too geeky here, but we say we're shortening up duration. Meaning you look at treasuries, like 10-year, 20-year treasuries, we're buying a little shorter duration because if rates go higher like we're expecting as the economy gets a little bit better, those longer term treasuries can struggle a little bit. So we're shortening up duration. We really like mortgage-backed securities. They're a little higher quality. We like higher quality fixed income. But also if rates go higher like we think and yields go higher like we think, mortgage-backed securities should not be as impacted by that. We also, so those are kind of how we see things. We also like investment grade, so good high quality bonds there for portfolios. Diversification is the only rational deployment of our ignorance. Peter Bernstein, rest in peace, Peter. That's a really good way to put it. So it always makes sense to have some bonds and obviously talk with Ward and try to make sure you get your portfolios in the right order. But again, we're a little overweight stocks, a little underweight bonds as we head into 2021. One of the main reasons, only 2 more charts, I think, then we're done. One of the main reasons is the 10-year yield was decimated last year. Okay, so yields were down, means bond prices were up. That happened early in the year. And again, the safety trade, people went to the safety that bonds provided. But it's kind of like think about a beach ball. Take it under the water, let go. Once you let go, you're not catching it. It's taken off, right? It's got a lot of momentum behind it. 10-year yields like that. 10-year yield was down a lot. And now all of a sudden it's starting to move higher. And with the new fiscal plans coming in, with Georgia going the way that it did, giving the Democrats control of the Senate and the House, more fiscal policy is likely. The 10-year yield's gone virtually straight up since then, pull back a little bit, but it had a really big run. So we think 10-year yield likely continues to go higher here, which could impact bonds a little bit. Last one, high quality bonds have held up well. All we're showing here is all the big corrections that we've had the last 10 years on the S&P 500. You can see there where it says S&P 500 index under return percent. Those are all the corrections, down 34% recently. And your Barclays Ag, think of that like your average bond fund was down slightly, but hey, did better than 34%. And then your longer term treasuries, which should really protect you when times are rough, they did very, very well. So all in all, there's always a place for bonds. And also, we've warmed for the first time in the 5 years I've been here to emerging market debt and actually high yield, or you call them junk bonds. We've kind of warmed to both of those for the first time in a while in the proper portfolio that's looking for a little bit more yield. So, always some opportunities there. We're about done here. The journey continues, got a long way to go, but hopefully I laid out a path that, listen, we think this bull market has a lot of life left to it. We think this economic expansion has a lot of time left to it. Things are really, really good right now, though. So do not be shocked, if you will, if we have a violent pullback, a well-deserved pullback, a consolidation for a while. I think that makes a lot of sense, but there's opportunities in some of the areas. We mentioned emerging markets, we mentioned Japan, we like small caps. Cyclical value, those are things like industrials and materials. As the economy opens up, we like those. Again, they haven't outperformed as well as kind of healthcare and technology. So maybe some of those other groups can kind of take the baton and have some participation. Good riddance 2020. It was such a rough year. Santa Claus got COVID, and the doctor asked him, list everywhere he's been. That's kind of rough. If you're Santa Claus, you've been a lot of places, so that's a rough one. Enjoy the moment. My dad passed away on the 13th, 3 years ago, January 13th, 3 years ago. There we are at Xavier University when Xavier was number 3 or 4 in the country, and they beat Villanova when Villanova was number 1 in the country. So, without our health, none of this stuff matters. Let's hope bonds go up. Let's hope gold goes up. And I think maybe I talk about gold here in the Q&A. Your commodities go up, your stocks go up, but without our health, none of this stuff matters. So wish everyone a healthy and lucrative, hopefully, 2021. So there's the slide again. You can send Michelle there your questions, and then I'm going to show a couple more disclaimers for a little bit, just to keep compliance in a good mood. We live in a highly regulated world for a lot of good reasons. We got to keep them happy as well. So I see you guys came on. I always have this worry that I just talked to myself for an hour and you couldn't hear me. So thank goodness you hear me. And okay, good. So I didn't just talk to myself for an hour. We're good.
Ryan, thank you so much for your presentation. You remind me of a friend who said to me one time, I'm going to talk quick, so listen fast.
Yeah. And I can talk forever, sorry.
Well, as I'm sitting here listening, it's just like the fire hydrant is wide open and there's just all of this stuff coming out. But one of the things that I appreciate, Ryan, so much is that it's not just information that's coming out. My father-in-law shared one time with me that, information is everywhere, and
Yeah.
knowledge is knowing what information is important, and then wisdom is knowing what to do with the knowledge that you have. And so I appreciate that you don't just spew information, but you share with us knowledge, and then you give us a head start maybe towards the wisdom, or you share your own wisdom. So just really, really appreciate that. Thank you so much. I think LPL made a great hire 5 years ago when they brought you on board, and I'm glad that you made the trip from Cincinnati down to Charlotte. I just wanted to clarify that you did not have to drive the golf cart from Cincinnati to Charlotte, though. I wanted to make sure.
No,
that
we
was...
bought the golf cart down here. That is true. We did not own one up there. That's a good point, though.
Well, I wanted to also give you another opportunity for a shameless plug. I think you referenced a couple of times lplresearch.com, and there is also a podcast that you referenced, and I just wanted to make sure that you were able to put that out there again.
Yes, thank you. Yeah, so lplresearch.com is our blog, and then LPL Market Signals is our podcast. You can get that on iTunes, Google Play, Spotify. If anyone listens to podcasts, where you get your favorite podcasts. Also, I'm on Twitter, also at Ryan Dietrich or at LPL Dietrich, where we share some thoughts on Twitter as well. So a lot of different ways you can see what I'm up to or what the LPL research team in general is up to. And that's a neat thing. We're held accountable. I do a weekly podcast about where we see things going, right? I mean, we're right or wrong. It's going to be one or the other, but we're held accountable. And that's a neat thing about, I think, LPL research in general.
Well, I know that I have access to you through all kinds of interactions through LPL. I have to say that I wasn't aware that there was a public access in terms of lplresearch.com and the market signals. And is that just market signals, or is it LPL market signals if people wanted to check out your podcast?
Yeah, you could simply Google LPL Market Signals podcast. You'd find it real fast, but it's LPL Market Signals. And we do have a YouTube channel too. You can do YouTube LPL research and you'll find it pretty quickly. We have a YouTube channel with a lot of cool videos.
Or maybe Google Ryan Dietrich, which is spelled Detrick,
Yes.
pronounced Dietrich, but spelled Dietrich. And so Ryan,
yeah, that's the American version. It's Dietrich, but hey, we came from Germany, so we Americanized it.
Well, that's great. So we did have a couple of questions that came in, and so we just wanted to clarify those. We have a couple of minutes here remaining. And in fact, you had mentioned a little bit about inflation, and you kind of alluded that you might get a question on gold. And in fact, that's the very first question that has come in is, what are your thoughts on gold?
Yeah, I mean, right here, Ward, we like it. Okay, we upgraded our view on gold, let's see, I guess 2 Septembers ago. Because again, I mentioned the US dollar. We think the dollar could be weak. Historically, a weak-ish dollar tends to support, and I say this, if you drop it and it hits your foot, it hurts. Okay, a weak dollar, if it falls and hits your foot, it's going to hurt. That's what the dollar helps when the dollar is going down. So we think gold has a lot of potential here. Now we're not gold bugs. We don't think that gold's going to go to like $10,000 an ounce, or maybe let's hope it doesn't, because honestly, that means we got a lot of problems. But gold outperformed stocks last year, and to be very honest, I wouldn't be that surprised if it happened again this year, because again, with all the spending that we're doing and inflation, one of the I said we don't see inflation yet. There's no inflation yet. Okay, yet I guess if you look at how much money, I mean, like eggs. I never bought eggs in my life until the pandemic, and now I'm buying eggs. Like, man, eggs cost a lot more than they used to a year ago. But there are some pockets of inflation happening. There's no doubt about it. But all the stimulus going on, and the Fed saying they're not going to hike rates for a couple of years, there is a cocktail, if you will, for potentially higher inflation, maybe say about a year from now. And gold is a nice inflation hedge. Really, any hard asset is an inflation hedge. So gold's one area that if more inflation comes, it can do well. Also, lastly on this, there's about 17 trillion with a T dollars of negative sovereign debt around the globe. Okay, that's a lot. So you got to know. So something like gold that has no dividend, but that's okay because everything else is negative. So that's another potential long-term tailwind, if you will, to maybe have a small portion of your portfolio in the safety that gold provides.
And so another question, Ryan, that came in, which is perhaps related. But you kind of alluded to already is all of this debt, a trillion here, a trillion there, and soon we're talking about,
Just
serious
counting.
money.
Yeah.
How does all this debt play in, and is this ultimately, eventually, not going to be a really big problem?
Yeah, I mean, I think the answer is it's going to be a big problem eventually, but it's kind of one of those not yet type of deals. Now, here's the way to look at this. There's a lot of debt in the US. There's no doubt about it. Like I said, we're adding a trillion here, a trillion there. I mean, a month ago, we did a $900 billion fiscal plan. That was the second largest fiscal plan in our country's history. It's almost like we forgot about it. Now let's go do this other big one. And I'm not trying to, I agree that it makes sense. You shouldn't have too much debt. I mean, I kind of grew up that way. You think about the 10-year bull market we just had with economic growth for 10 years. We only had barely 3% GDP in the best years. Why was that? You could have 10 people come on with you guys and give 10 answers. I think it's as simple as we had a ton of debt then. So it's tough to really get going, really have some significant GDP growth because that anchor of debt was keeping us down. Flip side is, though, to get you out of the trouble you're in, you do need to use debt. Now, the catch to this, though, all this is, our US debt. Check out consumers. Consumer credit card debt is down a ton over the past year. Last year, incomes went up. Now, I get it. A lot of it's because the government was giving people money. This was the first recession in history where FICO scores went up. The consumer is in really good shape, all things considered. Corporate America is in really good shape, all things considered. It's just the balance sheet of our country that's in trouble. And you can say that maybe continues to pressure the dollar lower, which is kind of the theme we just kind of talked about a little bit ago. So the truth is, if you say debt's high, it's true. But look at how much our country pays on its debt. Last year, Ward, we paid less on all of the debt, record debt we have now than we did 5 years ago. How can that be when debt's way up here compared to what it was 5 years ago? Interest rates. Interest rates are so much lower. So with interest rates this low, this is kind of the one of the few places where Washington on the left and right agree. China, being tough on China, is kind of the other one. Using more debt with rates historically low, kind of like we saw in the 50s with the big infrastructure plan then, that it makes sense to do it. But it's the ultimate question is when's it going to pop? When's there going to be too much problem? If the 10-year yield went up to 4 or 5% tomorrow, we'd be in a lot of trouble. I mean, that's the honest truth. The economy really need to pick up to make up for that, and that wouldn't be the case. But at least at this time, debt's out there, but we see corporate America and the consumer in really healthy shape, so we're not quite as concerned about it.
Yeah. Might be a good idea to think about 50 and 100-year treasuries, huh?
Yeah, I'll tell you, that could be a sign by itself. That's right, though. Yes.
Is there anything in particular, Ryan, that keeps you up at night right now? You mentioned LPL and the team there managing $50 billion in assets. What's keeping you up at night on the investment front? What are you concerned about?
Yeah, well, like I said, losing that basketball game's kept me up. But you're right on the investment front. I mean, we kind of hit on some of them already. I think that I started with this, the idea that things are really good right now. I mean, yeah, I traded options like you mentioned. I worked at Schaefer's investment research for a while, so I traded options. One of the things I learned there was using market sentiment as an indicator, and that's one of the reasons we upgraded our view on equities on March 26th when everyone else was panicking, because things were bad. Now things are good. So that inner contrarian in me looks at these polls and there's different, people are most optimistic they've been in a long time. That's great, but at the same time, that kind of worries me a little bit that the markets aren't that easy. Okay, it's not supposed to be easy. Mr. Markets, he's going to teach a lesson to a lot of people who Johnny come lately who think markets stocks always go up. We've heard that phrase a little bit lately. That kind of gets me a little bit that a well-deserved break could kind of break that up. And then I already talked, Corona, we're going to beat it, but you hear about, different potential strains that could happen. And fortunately, it looks like all the vaccines work. I mean, that's one of the wild cards. I have no idea, if this will happen or not. I mean, that's one of those things that can get you, but it's the unknown that you truly don't know about. Obviously, it's why it's called unknown. Those can worry. So I guess it's not even worth worrying about because you wait till it happens. But the inflation thing also, I talked about that a second ago. Inflation is one thing I think if you asked internally on LPO research, I'm a little more worried about inflation than some other people. I look at things like copper and nickel and steel, and corn is up 40% last year. These commodities are telling me, at least, the market signals I'm seeing, inflation is coming. Are we listening or not? I think inflation's on the way, and inflation's not a bad thing. We haven't had it for 10 years, so nobody knows what it's even like. But inflation's not always a bad thing. I want to make that very, very clear. But still, too much inflation can be a problem. That's the issue. But when inflation's running at 2%. Maybe we can get to 3.5%, this time in a year or two or so. But if inflation really gets roaring, that's when problems come. That's when the Fed has to hike rates, and that's when you stop your economic expansion. So we're not there yet at all, but the cocktail is there probably for a little bit more inflation down the road. And that's why you use gold and different hedges, if you will, to protect your portfolio.
Sure. So a little bit of inflation is good. A lot of inflation is bad, but also deflation is bad, and that's why we're trying to, walk that fine line. So good stuff. Well, we noted on March 18th that the S&P was 20% below the 10-day moving average. That had happened 3 previous times in the history of the markets. Each time that was the bottom, and sure enough. So we, as you know, we use a technical overlay as well. I love talking to you because it's fundamentals and technicals as well as sentiment. And so we use technicals as well. We saw a number of road signs. Yes, this was our first global pandemic that we had, per se, lived through, or, that had directly impacted us. But it was, there were some road signs that we saw on the technical highway that we'd seen previously. And we were able to use technical investing to both scale risk out, starting back in early March, and then also to begin scaling risk back in when we saw, around March 18th, March 23rd, as you said. So, well, Ryan, we really appreciate your time this afternoon. I think just a wealth of information, and we're certainly using LPL research as a significant data point in our portfolio construction and management here at Covenant. We greatly appreciate the partnership that we have with LPL, and again, just really want to affirm you as being a tremendous addition to the team 5 years ago. It's been our joy and pleasure to work with you behind the scenes, and now the second time that we've rolled you out front. And so I'm expecting another promotion this month based on what happened last time. And
let
so
Bert know.
we
go ahead and tell my boss. You know, Bert. Go tell Bert I need to know. I'd love it. That's fine.
I'll text him this evening. I'll text him this evening.
Great.
So
He'll be like, I just
we're a little bit
promoted him. Shut up. That's fine. Yeah, leave me alone.
We are a little bit over time, so I want to respect people's time and yours as well. So we'll go ahead and call it a wrap. And again, thank you so very, very much, Ryan.
Awesome. Well, thank you guys. I appreciate it. We'll see you very soon. Thank you.